Hello. This is the first lesson in the module FIN2601. It's the first recording in this module. So I'm going to be taking you through this module, and it's known as financial management. It's an introduction to financial management, and it's divided into 6 key study units. As you can see, we have the role and environment of managerial finance, financial statements and analysis, time value of money, risk and return, interest rates and bond valuation, and share valuation. So it's an important module which is divided into 6 study units. Today I am going to take you through one of these study units, and I would probably say the trickiest study unit you might come across in the exam. Study unit 2 is what I'm going to take you through, okay? But I'll just briefly tell you some things about study unit 1. We won't spend too much time on study unit 1 because usually they just ask 2 or 3 questions and they come in the multiple choice section. Most of the exam, if not all of the exam, at least maybe 95% of the exam is on these topics right here. The topics I'm highlighting. So in the exam, you're most likely to get 95% of the exam asking questions on these topics, and maybe just 5%, maybe even less, asking on the role and environment of managerial finance. Now, when it comes to the role and environment of managerial finance, you'll be familiar with a lot of the things that they ask about from your other studies. So these are the learning objectives for study unit 1. I'll just discuss them as I go through them. I'm not going to spend time here. I won't even give you notes. As an example, you'll see in this paper right here that was written in 2019, May, June. When it comes to that section, they can just ask maybe 4 marks, the 4-mark multiple choice questions, which are really straightforward, okay? So I'll just take you through this quickly without any notes, just discuss it. And then my notes will start with study unit 2, financial ratios. And then in the next video, it will be study unit 3. And then the one after that, study unit 4 and so forth, right? So for study unit 1, when you're getting ready for the exam, you don't have to spend too much time here. They say you need to know the functions of a financial manager. A financial manager raises money through financing and then invests that money through investing. So those are the 2 functions of a financial manager. Basically helping with raising money, which is known as the financing decision, and then investing that money, which is known as the investment decision. And then discuss the legal forms of a business organization. I'm sure you might have come across this in other studies. We have sole proprietors or sole traders who have their own businesses as individuals. We have partnerships. We have close corporations, and we have companies. Remember, companies are entities in which people have shares, whereas sole traders are individuals. And there's a lot of theory you need to go through here, but we won't spend too much time here. I'll just tell you where in the textbook you can find this. So I'll prepare something for you, just for you to read. You also need to know that the goal of the firm is to maximize the value of the firm and other concepts related to finance. You need to know about what we call the agency problem. Managers employed by a company are agents acting on behalf of shareholders. When you appoint someone to act on your behalf, we call them an agent. So when a company appoints managers, those managers are agents of the shareholders. You have to understand about financial institutions, where companies can raise money. But like I'm saying, this is not important. It's not as important as the other section, so we won't spend too much time here. And like I've shown you, at most you can get maybe 3 or 4 questions. And what I'll do as we get closer to the exam, I'll give you the answers to these theory questions, and then we can discuss about them. But for now, they're not as important as the calculations. That's what we want to focus on. So for study unit 1, don't worry too much about this, right? We'll work through it. But if you want to just read ahead and go through it, it's fine. They just look at the first study units in the prescribed textbook. Okay, sorry. But I'm not going to spend too much time on it for now. It's fine. We'll go through that when we're getting closer to the exam. Okay. So what I want us to really look at today, what's important, is I want us to go through study unit 2. This is what I am going to go through today. And study unit 2 is really important. It comes with a lot of marks in the exam. So my focus today is going to be on study unit 2. That's what I'm going to introduce you to. I'll be able to go through all this unit today, and then in the next video, you'll go through time value of money, maybe through 2 videos, interest rates and bond valuation and so forth, right? And you'll notice that financial statements and analysis consists of a large percentage of the exam. So it's really important. Like I've been showing you, if you look at the beginning of the paper, there were 12 marks on financial statements and analysis. So there are usually a lot of marks here. Okay, so I'll take you through this, and then I'll show you how you can do some calculations. Okay. So the first thing you need to know when we are analyzing financial statements, right? So we're going to be looking at financial ratios and financial statements. So when we're analyzing financial statements, we use what we call financial ratios. When we're analyzing financial statements, we use financial ratios. And a company can use financial ratios to compare its performance with competitors and to assess its performance through time. So a company might want to compare how it's performing with regards to profitability and other factors. They might want to compare their performance with competitors, or they might want to see how they've been performing through time. So they can use financial ratios, and they can also use financial statements and analysis. So we use financial ratios to analyze financial statements and to analyze financial statements. So there are 5 types of financial ratios that we can use to analyze financial statements and to make analysis. There are 5 types of financial ratios. We have what we call the liquidity ratio or liquidity ratios. We can use these to analyze company performance and to analyze how a company has been performing through time. We have activity ratios. We have debt ratios, profitability ratios, and market ratios. So in the exam, you should know which ratios fall under liquidity ratios. So under liquidity ratios, there are certain types of ratios we have. And for the exam, you should know which ratios fall under activity ratios. And likewise, for the exam, you should know which ratios fall under debt ratios, and you should know which ratios fall under profitability ratios and which ratios fall under market ratios. So you should know the types of ratios that fall under each of these groups for the exam. So I'm going to take you through the different ratios that fall under each group, and I'll be explaining what they mean. So you'll need to also memorize these ratios for the exam. So like I've told you, I probably think that this study unit 2, is probably the trickiest when it comes in the multiple choice section, because it's really mathematical. But I'll try to take you through it as best as I can. So usually I advise students in the exam to rather attempt time value of money first, risk and return first, interest rate and bond valuation, share value, to do these other topics first and then to finish off with financial statement analysis, because it's probably the trickiest study unit, but I'm going to take you through the study unit now. Right. Okay. So these are the 5 types of financial ratios we have. So let me look at each of these and then we'll work through some examples. So we'll start with liquidity ratios. So under liquidity ratios, we have 2 types. We have what we call the current ratio and the quick ratio. The quick ratio is also known as the acid test ratio. The quick ratio is also known as the acid test ratio. Now, this is the purpose of liquidity ratios. These liquidity ratios, these measure a firm's ability to pay short-term debts, meaning short-term obligations, right? So let's say you want to measure how well the company pays its short-term obligations, like its salary, its wages, its trade payables, meaning the money it owes on goods that is purchased on credit. We can use these 2 ratios to analyze how well the company can pay their short-term obligations. They are called liquidity ratios. The first liquidity ratio is the current ratio. The current ratio is given by the formula current assets over current liabilities, right? And the quick ratio is given by the formula current assets minus inventory over current liabilities. And then the higher these ratios are, the better. So something important here, you have to know what we mean by current assets, and you have to know what we mean by current liabilities. Okay, you have to know what current assets are and what current liabilities are. Let me just see if I can help you there by putting something up just to analyze to you what current assets are and what current liabilities are. Right? So you'll see there was a section B question in 2018 October, November, right, where you were supposed to calculate a lot of ratios. So if you notice this statement, financial statement, statement of financial position, you might actually know current assets and current liabilities from accounting. I'm sure you've done the first level accounting. But these are examples of current assets. Inventory is a current asset. Trade receivables are a current asset. Even cash and cash equivalents, things like that are current assets, right? And then current liabilities are things like trade payables, when you owe people money, or what we call accruals or short-term loans. Okay, so you have to be able to identify what current assets are and what current liabilities are. So for liquidity ratios, the higher the liquidity ratio is, the better. The higher these ratios are, the better, okay, when it comes to liquidity ratios. And then secondly, we have activity ratios. And then these ratios measure how effectively and efficiently a company uses its assets to generate profits and sales. These ratios measure how effectively and efficiently a company uses its assets to generate profits and sales. So these are known as activity ratios or efficiency ratios. So we have quite a number here, 3, 4, 5. We've got 5 of these ratios, right? We've got 5 of these activity ratios. Okay. The first activity ratio is known as the inventory turnover. This is given by cost of goods sold over inventory, right? And this ratio gives us the average number of times a company sells all its inventory over the course of a year. This ratio gives us the average number of times a company sells all its inventory over the course of the year. So for example, if we say the inventory turnover is 4, it means that on average the company sells all its inventory 4 times during the course of the year. So they place 4 orders of inventory. They sell the inventory 4 times on average during the course of a year. That's what we mean by the inventory turnover. And then the inventory turnover is closely related to the inventory days. The inventory turnover is closely related to the inventory days. And the inventory days is given by 365 divided by the inventory turnover. The inventory days is given by 365 divided by the inventory turnover. Sometimes this can be 360. They might say assume 360 days in a year, but in other words, this is the formula. So this ratio gives the average number of days it takes for a company to sell all its inventory. This ratio gives the average number of days it takes for a company to sell all its inventory. So for example, if the inventory days is 45, it means on average it takes the company 45 days to sell all its inventory. Okay. Then the third one is known as the average collection period. Average collection period. And then this one is given by accounts receivables over the average credit sales per day. I've put the credit in brackets because sometimes we just say average sales per day. So this is known as the average collection period. It's the accounts receivables over the average sales per day. Or we can also say account receivables over the annual credit sales times 365, right? If they give you the average sales per day, you can use this formula right here. Let's say they've given you the accounts receivable and the average credit sales per day, you can use this one, or the average sales per day. But if they don't give you the average and they give you the total sales or the total credit sales, then you can use this formula right here. So it will also depend on the information given. Personally, I prefer you use this one. But if you've been given the average credit sales per day, then you can just divide directly. So it will depend on the information that you've been given. Okay. And what does this ratio tell us? This ratio tells us the average number of days it takes for the company to collect cash from credit sales. Okay, it gives us the average number of days it takes for the company to collect cash from credit sales. So the lower it is, the better. The company will try to make sure that they collect money on credit sales as early as possible to avoid their money being tied up with customers. Right. So here it is. This ratio gives the average number of days it takes for a company to collect credit sales from debtors. The shorter it is, the better. Then we also have the fourth ratio, the fourth activity ratio, known as the average payment period, APP. This is given by accounts payable divided by the average credit purchases per day. If they don't give us credit purchases, we can just use the purchases. So we take accounts payable divided by our average purchases per day. Or, so if they've given us the average purchases per day, we can use this ratio. But if they've given us annual purchases, we can use the second one. We take our accounts payable, also known as trade payables, over annual purchases times 365, okay? And this ratio gives us the average number of days it takes for a company to pay its credit purchases. This ratio gives us the average number of days it takes for a company to pay its credit purchases. The longer the rate, like that period. So this ratio tells us how long we as a company take to pay people we owe money. That's the way. Okay, compared to the average collection period we had explained for us to collect on credit sales, right? And then the last activity ratio is known as the total asset turnover ratio, and this is given by sales divided by total assets. It's given by sales divided by total assets. So this ratio measures how efficiently a company uses its total assets in generating sales. It's a measure of how efficiently a company is using its total assets to generate sales. So the higher this ratio is, the better. Now, I just want to show you an example of how a question can be asked in the exam or in an assignment. This one is a bit tricky, but it's an example. It's an example of how a question might be asked. Okay, so let's look at semester 1, assignment 1, question 4. Semester 1, assignment 1, question 4. There we go. This question right here. Okay. So this is first semester, assignment 1, semester 1, question 4. And we've been told Dream Plug Management has announced that the company has current assets of 14,959 and a current ratio of 1.3. The company had cost of goods sold of 13,134 and a quick ratio of 1. What is the company's inventory turnover? So far I've introduced you to all these ratios. You're now familiar with what a current ratio is. You now know what a quick ratio is, and you know what an inventory turnover ratio is, right? I've taken you through that right here, right? These are the current ratio and quick ratio. We now know these, and we know what the inventory turnover ratio is, okay? So they want us to determine the inventory turnover ratio, right? The idea behind ratios is that when you read the question and you see what's being asked, always start by writing the formula for what you want to find. That's always the starting point. You simply stop, read the question carefully, and write down the formula of what you want to find. Right? So that's always the first thing. So we want to find inventory turnover. That's where we are. We want to find inventory turnover. And our inventory turnover is given by cost of goods sold over inventory. So that's where you start. You start with your formula. And then you go to the case study you've been given and you try to look to see if they've given you cost of goods sold and they've given you inventory. If they have, you just plug them in and then you get your answer. So next, check if the information needed to calculate the ratio has been given. Cost of goods sold, fortunately, has been given. It's 13,134. However, inventory has not been given, right? So we have a problem here. This has not been given. We need to calculate this, right? So now the idea is if one of these items that you need hasn't been given, you then need to use one of the other ratios that you've been given to calculate whatever is missing. I'll repeat that again. If one of the items you need to calculate your ratio hasn't been given, you now need to use one of the other ratios to calculate whatever is missing so that you can substitute here and you can get the answer you're looking for. So you then write out the formulas for the other ratios that you've been given. The other ratio we've been given is the current ratio and the other one is the quick ratio. So one of these ratios or both of these should help us to get the inventory, right? So you write the formula for the current ratio, which is current assets over current liabilities. You write the formula for the quick ratio, which is current assets minus inventory over current liabilities. So we need to use some maths here to get the inventory. This is where things can be a bit tricky, right? So I know that I need to use this formula because it's the one that has inventory. I need to get this inventory amount using this formula right here, using some maths. So the first thing I need to do here, first, I need to get my current liabilities using the current ratio. And then after getting those current liabilities using the current ratio, I'm going to substitute those current liabilities into the formula for the quick ratio. And then I'll solve for my inventory. Okay. So my current ratio is given by current assets over current liabilities. My current ratio is 1.3. It's equal to current assets, which are 14,959. We've been told that, divided by current liabilities. So here I need to solve for current liabilities. So how do I solve for current liabilities here? I do some cross multiplying, right? Remember, if you want to solve for something that's unknown at the bottom and you have a number here and here, it means you divide. You just change the positions of these two. That's a very important rule. You just simply change the positions of these two. This current liability comes here, and then this number goes to the bottom. Remember, if the unknown is at the bottom, you just take whatever you have. These two just switch positions. It's cross multiplying, right? Okay. So we say 14959 over 1.3, right? 14959 over 1.3. 14959 divided by 1.3, and we get 11,506.92, right? So these are the current liabilities. Okay, so we are now going to take these current liabilities and we're going to substitute them here along with the current assets that we already have, right? And then we are going to solve for inventory. So next we substitute into the quick ratio formula to calculate the inventory. So now we want to get the inventory. Remember, we're trying to get the inventory so that we can substitute it here. So we weren't given this inventory, so we are using the other financial ratios to help us to get that inventory, right? So next we substitute into the quick ratio formula to calculate the inventory. So this gives our quick ratio is equals to current assets minus inventory over current liabilities. We've been told that our quick ratio is 1. So we say 1, which is the quick ratio, is equals to current assets of 14,959 minus the inventory I, which is what we want to find, over the current liabilities, right? Sure. So now we need to solve for this I, okay? So there's some maths involved again, right? You see this 11,506.92 is at the bottom. We take it to the other side so that it multiplies with 1, right? So we say 1 times 11,506.95, and then it will be equal to this top part, which is 14,959 minus 1, right? And then if we simplify this, we get 11,506.95. Then we take this to the other side, this amount, so that we leave this inventory by itself. We take, it's a bit of maths in the exam. I'm sure it won't be this bad, so don't be a bit alarmed. But the idea here, we want to group like terms to leave this inventory by itself. So we take this inventory to the other side, right? And then it becomes a positive. Then we take this 11,506 to the other side, and then it becomes a negative because it was positive this side. Okay, so we just take this, right? And we take it to the other side, right? And then we take this inventory and we take it to the other side. And remember, whenever you take something to the other side, its sign changes. That's why this inventory was negative, then it became positive. This one was positive, then it became negative, right? Something else that's important to note, the assignment tends to be a bit harder than the exam. As you can see, this example is a bit, but don't worry about that. So then we get our inventory. Then lastly, we can now substitute our inventory. We take our cost of sales divided by our inventory, and we get the inventory turnover. So now I have an exercise for you. There's a question I want you to do to try to see if you can try to replicate what I was doing. Remember, these are the steps. With any question on a ratio, firstly, read the question carefully and write down the formula of whatever you want to find, right? After writing down the formula of whatever you want to find, try to see if what you need to use in that formula has been given. If some of the things you need to use in that formula haven't been given, it means you need to use another financial ratio to get whatever is missing so that you can get the answer. Okay. So let's look at May, June 2018. I want you to have a go at question 9, May, June 2018. Right, this question right here. Right, so what I want you to do for this question, I want you to put the video on pause, right? And I want you to attempt this question. I want you to try to calculate the quick ratio. Please, it's good if you practice. If you practice, it means you can pick up if you are having struggles with any particular area and so forth, and then you can see how I calculate it so that you can learn from where you're making mistakes. So put the video on pause, write down the formula for the quick ratio. After writing down the formula for the quick ratio, check to see if you've been given everything you need for the formula. If something you need for this formula is missing, it means you need to use another ratio, maybe the inventory turnover ratio, to get whatever is missing to calculate the quick ratio. Then you substitute, get whatever is missing, plug it into the formula for the quick ratio, and you get the answer. So please put the video on pause, give that a try, and then when you're done, press continue. Then you can see my answer and how you did the question and whether you were able to do that. Okay. Okay, so hopefully you were able to do this calculation, and hopefully you got 1.86, which is option 2. I'll now take you through how we do this. So the starting point is always you first write out the ratio of whatever you want to find. In this case, our quick ratio is given by current assets minus inventory over current liabilities. This is the formula for the quick ratio, right? So we substitute everything. We have our current assets, right? Our current assets have been given. It's 89,602. We have our current liabilities. Our current liabilities are 36,125, but we have a problem. We don't have our inventory, right? There's no inventory here. So we need to use another ratio to help us to get inventory. So we need to calculate inventory using other ratios or another ratio. So the other ratio we've been given here is the inventory turnover. So we'll use the inventory turnover to get inventory, then we'll substitute it there. Inventory turnover is equals to cost of goods sold over inventory, right? So we take our inventory turnover of 3.47 is equals to cost of goods sold, which is 77,538 over inventory, which is I. So remember what I told you. I said if you have an unknown at the bottom and you have a number here and you want to get what this unknown is, they can just swap positions. So it means our inventory will simply be 77,538 over 3.47. These two will just swap positions, right? These ones, these two will just swap positions, okay? These two, because the unknown is at the bottom, so they become like this. This is the new, and then if we divide, we get inventory there, and then we simply substitute that inventory into our formula. It will be current assets minus inventory over current liabilities, then we get 1.86. And then please note, with this question, right, you need to be careful with how you do this question, especially with your calculator. It's possible to make mistakes here, right? The idea is that you proceed as follows, just to make sure that you are fine with your calculator technique. Let me just illustrate this. There we go. So to do this calculation, you would say open bracket 89602 minus 22345.24 close bracket divided by 36125, and then you get the answer, which is 1.86. Some students will incorrectly say 89602 minus 22345.24 divided by 36125. Now this is wrong. You see, the brackets were not put here. You need to put the brackets for the top part. You get the top part of the calculation, and then the answer for that is divided with the bottom part. So please make sure your calculator technique is fine. Okay, so let's look at the remaining ratios. The next ratio we have, so there are three types of remaining ratios left. Let me just finish those off. So we have debt ratios. These are the third type of ratios. And under debt ratios, we have two types of ratios you need to know. We have these ratios measure how solvent a company is. In other words, they look at the amount of debt that a company has, long-term debt. They look at the amount of long-term debt that a company has. The less long-term debt a company has, the more solvent the company is. Okay, so the less debt you have, the more solvent you are as a company. So the debt ratio is given by total liabilities over total assets. The debt ratio is given by total liabilities over total assets. And when you're working with this equation, this debt ratio, it's always important to remember the accounting equation. Remember, the accounting equation says total assets is equals to total equity plus total liabilities. Total assets are equal to total equity plus total liabilities. Okay. Then there's also what we call the time interest end ratio. This is the second debt ratio. This is also known as the interest coverage ratio. This is also known as the interest coverage ratio. And it's given by earnings before interest and tax, EBIT, also known as operating profit, divided by interest expense, which is also known as finance costs. So this ratio tells us how well the company is at paying its interest expense from its operating profits. The higher it is, the better. And remember, I've told you that EBIT is also known as the operating profit. So when you're using this ratio, you need to remember the basic format of an income statement. You need to remember that when we're working with an income statement, we take our revenue, then we subtract the variable costs, also known as the cost of sales, and we get the gross profit. Then we subtract our operating expenses, then we get the operating profit. Then we subtract our interest expenses, then we get the earnings before tax. Then we subtract tax, and then we get net profit. So this is the basic format of an income statement. You might need to use it when you're answering questions on the time interest and ratio. It's also important to remember this. And sometimes you need to get interest expense when you've been given net profit. Sometimes when you've been given net profit, you need to add back tax, and then you need to add back interest expense, so that you can get your operating profit, and then you can substitute the operating profit here, which is EBIT divided by the interest expense. So if you want to get the tax expense, let's say you want to add back tax to the net profit such that you can get earnings before tax, and then you want to add back interest expense. I shouldn't have put to get interest expense. I should have said to get the tax expense. This should say tax expense. Our tax expense is given by the tax rate multiplied by the net profit over 1 minus the tax rate. And then we can add that back to net profit and the interest expense, and we can get operating profit. So to illustrate how this might be asked in a question, let's look at May, June 2017, question 11. May, June 2017, question 11. Sorry. May, June 2017, question 11. So the question says, Florist Company has an interest expense of 15,000 Rand, profit for the year of 63,000 Rand, and a tax rate of 30%. What is the company's times interest and ratio, also known as the interest coverage ratio. What is the company's interest coverage ratio? Okay, so that's what they want us to get here. What is the company's interest coverage ratio? The times interest and ratio. So as usual, if you've been asked to calculate any ratio, you always start by writing the formula of the ratio you want to get. We know that the times interest and ratio is given by EBIT divided by interest expense, right? So you check to see the information you've been given. Have we been given EBIT? We haven't, but we have been given the interest expense. So we have to calculate the EBIT. And then our EBIT is given by net profit plus the tax expense plus the interest expense. This is how we get EBIT. We simply start with our net profit, then we add back tax, then we add back interest expense, and then that gives us our EBIT, also known as the operating profit. So we were given the net profit and we were given the interest expense, but we were not given the tax expense. So that's where I said that the tax expense is calculated using this formula. We just say tax rate times net profit over 1 minus tax rate. Our tax rate is 30%, right? So we say 0.3 multiplied by the net profit of 63 divided by 1 minus the tax rate divided by 1 minus 30%, and we get 27,000. Again, here you need to be careful when it comes to your calculator to avoid making mistakes, right? 30% is 0.30. We say 30 divided by 100 times 63,000, right? So we get this answer, which is 18,900, right? And then we say 18,900 divided by, open bracket, 1 minus 30%, right? And we get 27,000. Okay, so that's important. You need to make sure that you are comfortable with your calculator when it comes to those calculations. And then we simply take our net profit, add back the tax expense and the interest expense, and then we get 105,000. And then our time interest and ratio will be the EBIT divided by the interest expense, and we get the times interest and ratio of 7, which is option 2. Okay. Next, so there are 2 types of groups of ratios left: profitability ratios and market ratios. So I'll quickly go through those. The first profitability ratio is the gross profit margin ratio. This is gross profit over sales times 100. Please remember that gross profit is equals to sales minus cost of sales, right? So this gross profit margin, this ratio gives the percentage of each dollar remaining from sales after paying for cost of goods sold. So if we say the gross profit margin is 20%, it means that for each 1 rand of sales, the company had 20 cents left after paying for its cost of goods sold. Okay. And something important to note, you'll note that all the profitability ratios that have margin are divided by sales, just like the gross profit margin is divided by sales. Then the operating profit margin is given by operating profits, which is EBIT over sales, operating profit over sales, EBIT over sales, right? And like I said, every ratio with margin is divided by sales. So this is also a percentage because this times 100. And this is the percentage of operating profit in each rand. Sorry, it should say rand here. I was using the soft copy of the book. It uses dollars because it's an American book. So this is the percentage of operating profit in each rand of sales. Right, that's the operating profit margin. So if your operating profit margin is 10%, it means for each rand of sales, the operating profit was 10 cents. The net profit margin is given by net profit minus preference share dividends divided by sales times 100. So this is also a percentage. And this gives the percentage of net profit in each rand of sales, not dollar, it should say rand. And it's a margin ratio again, and it's divided by sales. But importantly, you first subtract preference share dividends. Then we also have what we call earnings per share. It's net profit minus preference share dividends over the number of ordinary shares outstanding. This is earnings per share, the profit to each shareholder per each share they hold. We also have return on assets. This is net profit minus preference share dividends over total assets times 100%. Remember, whatever we put on the top here, remember it should be in brackets, right? It should be in brackets. You always calculate this first before you divide it. Okay, so that's important. And the return on assets, this gives the return on investors' investment into the company. So if the return on assets is 35%, it means investors had a return of 35% on their investment. And then return on equity is given by net profit minus preference share dividends over ordinary share equity times 100%. And this gives the return on ordinary shareholders' investments as a percentage. And then the last group of ratios are what we call market ratios. The last group of ratios are market ratios. We have the price to earnings ratio, which is given by the market price per share over the earnings per share. And this gives a number of investors. This gives a measure of the investors' confidence on future performance of a share, right? So the higher the price to earnings ratio is, the more confident investors are on the performance of the share in that company. And we also have the market to book ratio. And the market to book ratio is given by the market price per share divided by the book value per share. Sometimes you need to calculate this book value per share. The book value per share of ordinary equity is given by the ordinary shareholders' equity divided by the number of outstanding ordinary shares. So they'll give you this information in the question. Right, so the last thing you need to know in study unit 2 financial statement analysis is what we call the DuPont analysis. We have something that we call the DuPont analysis, and big questions with a lot of marks have come before in section B on this, so it's important to note. And this DuPont analysis, this is simply an analysis that can be used to analyze return on equity. It can be used to analyze and calculate return on equity, as well as return on assets, right? So this DuPont analysis, we can use it to analyze and calculate return on equity and return on assets. Remember, I have given you the formula for return on assets and return on equity, right? These two formulas. But DuPont is a shortcut to calculate those two. So according to DuPont, return on assets is broken down into two parts. The DuPont analysis says that the return on assets is equals to the net profit margin multiplied by the total asset turnover. So the DuPont analysis says if you simply want to calculate return on assets, you don't have to worry about this formula right here. If you've been given the net profit margin and the total asset turnover, you can simply just multiply these two and they can give you return on assets. And this means if we want to increase the return on assets, we can increase our net profit margin or we can increase our total assets turnover. On the other hand, the DuPont analysis says that return on equity is broken down into three parts. So with DuPont, return on equity is actually broken down into three parts rather than using that other formula I gave you. We say return on equity is equals to net profit margin times total assets turnover times financial leverage multiplier. So we can just multiply these three items and then we can get return on equity. So they will give you these items and they'll say calculate return on equity. You just multiply and you get return on equity. And then since net profit margin multiplied by total asset turnover gives us return on assets, right? It means that we can also get return on equity by simply multiplying return on assets times the financial leverage multiplier. So always be on the lookout for that in the exam or in an assignment, right? If you're asked to calculate return on equity or return on assets, always try to see if maybe you need to use DuPont to avoid the maths, whereby you can just multiply and you can get your answer. Okay. So I've taken you through this study unit. Let me see my study guide is. I've taken you through study unit 2, financial statement analysis, right? And I've shown you the important things you need to note for the exam. The next 2 videos will touch on time value of money, and then after that we'll look at interest rates and bond valuation, risk and return, and then share valuation. Okay. So I want you to try some questions for homework. I want you to try May-June 2018. May-June 2018. I want you to try question 5 up to question 13. Yes, question 5 up to question 13 as practice. Okay, I want you to try these questions. These are just questions on financial statement analysis and ratios, what we've been going through. But remember, when you're answering these questions, just to make things easier for you, always start by writing down what you want to find. Then try to see if you've been given all the information for what you want to find. If you haven't been given all the information for what you want to find, you need to use another financial ratio to get whatever is missing. Then you can substitute it in and you can get the answer. So please give these a go. And then in the next video, I'll give you the solutions to each of these questions and you can compare with what you've done. Practicing is very helpful, right? So that brings us to the end of the recording for FIN2601, right? I hope the recording has been helpful. If you have any queries or questions with regards to anything I was covering in this recording, please feel free to contact me. My number is up there on the screen if you don't have it. I might not always be able to get back to you promptly due to business and other commitments, but I'll try to do so as soon as I can. Thank you once again.